Debit feels safe. Credit pays rewards. Both can backfire. We'll bust the biggest myths fast. Why carrying a balance never helps your score.
How fraud liability really works, and when to use each card for hotels, rentals, and everyday buys. Stay for the simple rules to protect cash flow and win the math. Winath.
Okay, let's unpack this. We have to start with a number that is, well, frankly terrifying, and it impacts nearly every household in America. $1.21 trillion.
Yeah, that's the total outstanding U.S. credit card debt recently reported. It's an alarming high mark.
It really is. And when you see a figure that huge, it feels overwhelming, right? But the core issue often boils down to something pretty simple. It's about a choice you make, every day, right there in your wallet.
Exactly. Most people, they carry these two pieces of plastic. They look almost identical, don't they? 16 numbers, a chip, a logo.
Yep. But one uses your money, like your actual cash from your account, and the other, that uses the bank's money.
And deciding which one to whip out, it's not just about paying for coffee or groceries. It's a strategic move. It can really determine if you're building up your financial future or maybe tearing it down.
So our mission here in this deep dive is really to cut through all the noise, all the marketing confusion.
Right. We want to give you a clear sort of strategic roadmap, how to use both cards, effectively.
We need to figure out which card in your wallet is setting you up for success, and which one could, maybe, leave you stranded trying to run a car, or worse.
Or worse, staring at an empty, frozen bank account because some hacker got your details.
Yeah. Okay, so let's jump right into the absolute basics, because everything else kind of flows from this one question. Whose money is it anyway?
Let's start with the debit card. It's the simplest concept, really, and that's why so many people, they feel comfortable with it.
Makes sense.
The money comes straight out of your checking account. It's your money right here, right now. The huge pro there, discipline.
Oh, okay.
Forces you into strict budget control. You have the money.
Before we slay, hit subscribe, ring the bell, and leave some love.
You spend it. If you don't have it, transaction denied. Simple as that.
But there's a catch, right?
Oh, yeah, a big one. First, a debit card does absolutely nothing to build your credit history. Zero. And second, if you slip up, if you mismanage your balance, you're looking at overdraft fees. And those can be painful. Sometimes they even stack up.
Okay, so that's debit. Now, credit cards. Fundamentally different beast.
Totally different. A credit card is essentially a short-term loan. The bank or whoever issued the card sets a spending limit, and you're borrowing their money up to that limit.
Right, the bank's money. So what's the upside?
Well, for someone who uses it responsibly, the upside is potentially enormous. It's the main way most people build a solid credit score. And you need that score for the big things in life, like buying a house or a car.
And the rewards, of course. Can't forget those.
Exactly. Aggressively chasing rewards, cashback, travel miles, points, that's a big draw. But the risk is the APR, the annual percentage rate.
That's the interest, right?
That's the interest, and it kicks in the moment you don't pay that balance off in full by the due date. That short-term loan suddenly starts turning into, mounting debt, and often at a really high interest rate.
So how does this play out in the real world, like in the market?
Well, it's interesting. Non-cash payments, they totally dominate the U.S. economy now, obviously. But recent data, we're talking 2024, 2025 figures, show a really significant shift.
Oof, what kind of shift?
Credit cards have actually surpassed debit cards in total transaction value, so people are spending more dollars via credit.
Wow. Do we know the numbers on that?
Yeah, roughly, credit's accounting for about 35% of total consumer transaction value, while debit is sitting around 30%.
So credit's actually leading now. Why do you think that is? Is it just convenience or?
It seems to be driven by a couple of big things. One, consumers are actively trying to maximize those rewards we talked about. They're optimizing.
Especially for bigger purchases, maybe online.
Exactly. And two, maybe even more importantly, is the perception and the reality of better protection.
Okay, protection. Let's dig into that because you hear this all the time. It feels like the biggest myth, maybe. The security showdown. People constantly say, I only use debit. It's safer. I can't overspend. And, my actual money feels more locked down.
Right. And that emotional argument, it's incredibly powerful. This idea that you're keeping the bank sort of at arm's length from your immediate cash.
Yeah.
but legally and practically. It's just, well, it's flat out wrong. Credit offers superior protection. It's almost ironclad, actually.
How so?
Under the Fair Credit Billing Act, your legal liability for fraudulent charges on a credit card is capped, maximum $50.
Just $50.
$50 max. And on top of that, almost every single credit card issuer today offers a zero liability policy anyway. So usually you're liable for nothing.
Okay, but hang on. Don't a lot of banks offer zero liability on debit cards now too?
Yeah.
I feel like I've seen that advertised.
They do, yes. And that's good. But here is the absolutely essential difference. It's whose money is missing while things get sorted out.
Okay, explain that.
When fraud hits your credit card, the bank investigates using the bank's money. Your cash flow, your rent fund, your grocery money in your checking account, it's completely untouched. The bank takes the hit while they figure out what happened.
But if fraud hits your debit card.
And that money is pulled directly, instantly from your checking account.
Yeah.
Your money is gone. Exactly. This is what we call the debit card liquidity risk. It's the thing that fuels all those nightmare stories you read online, like on Reddit.
Yeah, I've seen those. Account drained. Frozen.
Right. Your account gets completely drained, maybe even frozen, while the bank investigates the fraud. And even with that zero liability promise, the investigation takes time. Could be a day or two, could be weeks in some cases.
And in the meantime?
In the meantime, if you needed that money right now, for rent, utilities, gas, you're stuck. Your financial life can be severely disrupted instantly. That buffer you get with a credit card, it's invaluable.
Okay, so just based on security, keeping your cash available.
Don't miss a beat. Hit subscribe, ring that bell, and show some love with a like.
Credit cards offer a crucial buffer, especially for, say, online shopping or any transaction where maybe you're not 100% sure about the vendor.
Absolutely. Or just any purchase large enough that having that money disappear temporarily would cause you real problems.
Which leads us right back to that $1.21 trillion debt figure. Why are people seemingly willing to take on that liquidity risk with debit just to avoid credit? It must be psychological.
It absolutely is. We have to look at the psychology of spending. This is where things get really fascinating and, frankly, a little scary.
How so?
Well, psychological research, study after study, shows that using credit cards significantly reduces the pain of payment.
The pain of payment.
Yeah. When you swipe that plastic, you don't see the numbers in your checking account drop in real time like you do with debit. There's a mental distance. Money becomes more abstract.
Okay, I can see that.
And that distance makes people demonstrably prone to spending more. Significantly more. Some studies suggest people might spend up to like 100% more with credit than if they were using cash.
Double. Wow.
God.
That definitely helps explain the debt crisis.
It's the engine driving it. But we also have to acknowledge the flip side. There's a powerful anti-credit movement that's popped up specifically because of this psychology, most famously championed by, Dave Ramsey.
Right. And we need to talk about that viewpoint impartially because it provides a really strong sense of financial discipline for millions of people.
Absolutely. Ramsey and what you might call the debt-free community, they argue that rewards are
Don't forget to subscribe, tap that bell, and let's chat below.
basically an illusion, a trap, designed to make you spend more than you otherwise would.
And the risk of that high APR just isn't worth it.
Exactly. They say the risk of high interest completely outweighs any tiny benefit you might get from points or cash back. Their advice, which many follow very strictly, is simple. Cut up the cards. Stick to cash or debit. Unshakable discipline.
And that philosophy, it seems to resonate particularly strongly with younger generations, right? Like Gen Z.
It really does. Gen Z, so generally folks under 27 or so, they seem inherently debt averse. They grew up watching older generations, maybe their parents, struggle with student loans, with revolving credit card debt.
So they prefer debit for everyday stuff.
Often, yes, for the control. But they're also pretty savvy. They understand they need to build a credit score for the future.
So how do they square that circle?
Well, often they'll start with things like secured credit cards.
Yeah.
Or we see the huge boom in BNPL buy now, pay later services.
The pay in forward kind of deals.
Precisely. They often see BNPL as maybe a safer, more controlled way to make larger purchases on a payment plan without the risks of a traditional revolving credit card.
Okay, so that's Gen Z. What about, say, millennials or maybe higher earners?
That group often behaves very differently. They tend to be the optimizer.
Optimizers.
Yeah, they're playing a sophisticated game. They're trying to maximize every single dollar. They track loyalty programs. They apply for cards strategically just to get the sign-up bonuses. They use complex debt payoff strategies like the debt avalanche method.
So they're trying to leverage credit.
Exactly. Their goal is to leverage credit to get the best possible terms on those huge life purchases, like mortgages or car loans. For them, a high credit score isn't just nice to have. It's like a key piece of their personal financial infrastructure.
Okay, this is great context. Let's pivot from the philosophy and the psychology. Let's get really practical.
Actionable.
What does all this mean for your wallet day to day? Let's map out some specific situations. When should you definitely use one card over the other?
Sounds good. Let's start with a classic headache scenario for anyone who travels. Renting a car or checking into a hotel.
Okay. Recommendation here.
Use the credit card, no question.
And why is that so critical?
Because rental car companies, hotels, they always place a hold on your card, a security deposit, basically. Often it's significant, maybe $200, $500, sometimes more.
Right.
If you let them put that hold on your debit card, that cash is immediately deducted from your checking account. It's gone, unavailable. And sometimes, I've personally seen this, those holds can take a week, even longer, to get released after you check out or return the car.
Which could leave you short on cash during your trip. Huge problem.
Huge problem. But if that hold goes on your credit card, it just temporarily reduces your available credit limit. It doesn't touch your actual cash in the bank, avoids that immediate cash flow disruption.
Plus, don't some credit cards offer perks like rental car insurance?
Yes. That's another big reason. Many premium travel cards offer free primary rental car insurance. That means you can decline the expensive collision damage waiver, the CDW they try to sell you at the counter. That alone can save you, $20, $30 a day sometimes.
Okay, good tip. Scenario 2. Building your financial foundation. Your credit score.
Recommendation here, use a credit card, but responsibly.
And why is credit so essential here?
Because, like it or not, credit isn't really optional in the U.S. financial system. It's vital infrastructure. Not having a credit score or having what they call a thin file with very little history can be almost as damaging as having a bad score when you go to apply for a mortgage or even just get a decent rate on a car loan.
Okay, so you need to use credit, but how do you do it responsibly? What's the key?
The golden rule. It's absolutely non-negotiable. Use the credit card only as a payment method. Never, ever treat it like a loan, meaning you treat that credit limit just like it's your debit card balance. Only spend money you actually have sitting in your bank account right now.
And crucially,
pay off the full statement balance every single month. No exceptions. On time.
that's how you avoid the interest, the APR.
That's how you avoid interest entirely. And one more technical tip. Keep your credit utilization low. That's the amount you owe compared to your total credit limit. Aim to keep that below 30%, ideally even lower, like under 10%. That one factor heavily influences your score.
And for people just starting out, maybe young adults, students.
Secured cards are a great starting point. You put down a cash deposit, and that usually becomes your credit limit.
Yep.
Or there are special credit builder loans. Both are good, low-risk ways to start building that positive payment history.
Okay, final scenario. The everyday stuff. Your morning coffee, your weekly groceries, grabbing lunch.
Right, the small daily purchases. Here, honestly, the choice is much more personal. It really comes down to balancing your own discipline against optimizing for rewards.
So debit for control. Credit for rewards, maybe.
Pretty much. Use debit if you absolutely want that strict budget control, that psychological safety net of seeing the money leave your account immediately. Use credit if you're chasing rewards, but only if you have ironclad discipline.
And this brings us right back to the math, doesn't it? The math behind that $1 trillion debt.
It does. You have to ask yourself the critical question, are those rewards really worth it? Meaning, if you're chasing, say, a 2% cashback reward, right, but you slip up sometimes, you occasionally carry an average balance of maybe $2,000. And the typical credit card APR is, 22% nowadays?
Yeah, easily. Sometimes higher.
The interest you'll pay on that $2,000 balance will completely wipe out any 2% reward you earned, and then some. You'll end up paying far more in interest than you ever got back in rewards.
So the math is simple, but sticking to it is hard.
Exactly. The only way to truly win the rewards game is to pay your statement balance in full every single month without fail.
The credit card companies are banking on people not doing that.
That's their business model, essentially. It relies on what they call breakage people, slipping up, carrying a balance, paying interest. That slip up is what fuels the entire system and that trillion-dollar figure we started with.
Okay, wow. Let's try and synthesize all this for everyone listening. We've found that this whole credit versus debit thing, it isn't just about money, is it? It's really a deep psychological battle.
Yeah.
It's control versus leverage.
That's a great way to put it. Debit gives you that feeling of emotional safety, that immediate budget control. Credit, when used right, gives you strategic financial leverage. It builds that necessary credit history. And critically, it offers much better legal and practical protection.
So what's the final takeaway then? Is one definitively better?
You know, the optimal financial strategy is almost never all or nothing. It usually requires a balanced approach.
How so?
Maybe you use the debit card like a strict budget monitor for most of your small, everyday spending. Keep things tight there. And then you leverage the credit card responsibly as a tool. Use it for building your score, maybe maximizing rewards if you're disciplined, and definitely using those critical legal and liquidity protections for larger purchases, online transactions, or travel.
Right. Using the right tool for the right job.
Exactly.
Okay, so we've seen the U.S. debt crisis keeps climbing. We know the rewards game can feel rigged if you ever carry a balance. So here's something to think about, a provocative thought for you listening. Have you ever actually sat down and calculated the real return on investment, the ROI of your favorite rewards card?
Yeah, factoring in not just the points you earn, but any annual fee the card might have, and being honest about any interest payments you might have made, even occasionally.
That calculation, it can be a real wake-up call for some people.
Definitely. Or maybe think about your own experiences. Share them. Did a credit card ever save your vacation because it had some hidden benefit, like that rental insurance we mentioned?
Or, on the flip side, have you ever had that nightmare scenario where your debit card got hit with fraud and your bank account was frozen right when you needed the money most?
We genuinely want to hear those real-world stories. Share them in the comments below. Let us know what you think.
Absolutely. And hey, if this deep dive helped you understand how to protect your money a bit better, or maybe how to craft a smarter strategy for your own wallet, please do us a favor, hit that like button, and subscribe so you don't miss our next strategy session.
Yeah, we might just dive into how those buy now, pay later deals really stack up against a 0% APR credit card offer next time. That could be interesting.
Ooh, yeah, that's a good one. Definitely subscribe so you don't miss it. Thanks for diving in with us today.